All right, class, settle in. Today, we're going to dive into some of the trickier and, I think, more fascinating parts of Canadian tax law. We're talking about the special rules for capital losses. Now, these are the exceptions, the specific situations that build on the basic rules we've already gone over. And let me tell you, getting a handle on these is absolutely crucial, not just for your exams, but for any kind of tax work you might do in the future.
And just for the record, this presentation was prepared by Dr. Samir Al-Rashani with some help from AI support.
So, here's the game plan for today. We'll kick things off with a quick refresher on the basics of capital losses. Then, we'll get into the good stuff, the special exception for small business investments, how to recognize a loss when you can't even sell the asset, and the really important superficial loss rule. After that, we'll touch on the kind of weird rules for personal property and wrap up with a super practical tip about registered plans like your RRSP or TFSA. Sound good? Let's get started. Okay, Section 1, capital losses, the basics. We've got to start here because every single thing we talk about for the rest of this lecture is basically an exception or a twist on these foundational rules.
All right, here's the number one rule you have to burn into your brain. Capital losses can only be deducted against capital gains. That's it. Unlike, say, a business loss, you can't use it to lower your taxes on your salary or other income. Think of capital gains and losses as being in their own little sandbox. This is a core principle of the Canadian tax system, so you gotta know it.
So, you might be asking, what happens if I have more losses than gains this year? Good question. The system gives you options. You can take those extra or net capital losses and carry them back up to 3 years to get a refund on taxes you already paid on capital gains. Or, and this is pretty powerful, you can carry them forward forever, indefinitely, to use against any capital gains you have in the future. You can see how this makes timing your sales a really big deal for tax planning.
Okay, on to our next section. This is our first major exception to the rule we just learned, and it's a huge one. It's all about something called an Allowable Business Investment Loss. We just call it an ABIL. And it's specifically designed to encourage people to invest in Canadian small businesses. Now, before we can even talk about the loss itself, we have to know what kind of investment qualifies. An ABIL can only happen if you have a loss on shares or debt in what the Tax Act calls a small business corporation. So what's that? Well, it has to be a Canadian-controlled private corporation, or CCPC, and this is key. Almost all of its assets have to be used in an active business, not just sitting in passive investments like stocks or bonds. You'll notice the law uses that fuzzy phrase, substantially all. What on earth does that mean in practice? Well, thankfully, the CRA has given us a clear number to work with. Their administrative policy says substantially all means 90%. So at least 90% of the company's assets by fair market value have to be tied up in its active business. That's a hard line, and it's a really important test to meet. And this is why ABILs are such a big deal. They completely break that cardinal rule we just learned about capital losses being stuck in their own sandbox. An ABIL can be deducted against any kind of income, your salary, your business income, rental income, anything. This is a game changer because it dramatically lowers the risk of investing in a small Canadian business. If the investment fails, the government is essentially sharing in a much bigger chunk of your loss through tax savings. That's the whole point. All right, let's move on to our third topic, recognizing unrealized losses. This section deals with a really practical problem. Imagine you own shares in a company that's gone bust. The shares are worthless, but you can't actually sell them to anyone to trigger the loss. So how do you claim it for tax purposes? That's where something called a deemed disposition comes in. So yeah, think about it. What happens when your investment is completely worthless, but you literally can't find a buyer to formally sell it to? I mean, nobody's going to buy shares in a company that's dead, right? So how do you get that loss onto your tax return? Well, the tax law gives you an out. You can actually elect to treat the asset as if you sold it for $0. This is called a deemed disposition. You can do this in a few situations. For debt someone owes you, you can claim it once you've established it's a bad debt. For shares, you can make this election if the company is legally bankrupt. Or even if it isn't officially bankrupt, you can still do it if you can prove 3 things. The corporation is insolvent, it's stopped all its business operations, and its shares are now completely valueless. This lets you crystallize that loss and claim it, even without an actual sale. Okay, next up is a really, really important one. This is an anti-avoidance rule called the superficial loss rule. Its entire purpose is to prevent people from gaming the system. Basically, it stops you from selling a stock to get a nice tax loss and then immediately buying it right back so you still own it.
So here's the technical definition, and you'll want to know this. A superficial loss happens when you sell something for a loss, and you or someone affiliated with you, like your spouse or a corporation you control, buys the exact same property back. And this happens within a specific window, 30 days before the sale or 30 days after. So it's a 61-day window you have to watch out for. And the final piece is that you or that affiliated person still own the property 30 days after the original sale. Let's make this real with an example. So look at the table. You sell 500 shares for $8,000 that you originally bought for $10,000. Simple enough, that's a $2,000 loss, right? But you turn around and buy those same 500 shares back a week later for $7,500. Because you did that within the 30-day window, the superficial loss rule kicks in. That $2,000 loss is denied. It doesn't just disappear, though. Instead, it gets added to the cost of your new shares. So your new adjusted cost base, or ACB, is the $7,500 you paid plus the $2,000 denied loss for a total of $9,500. And that's the key takeaway here, so listen up. The loss isn't gone forever. It's just deferred. It's postponed. By adding it to the cost of the new shares, you'll get the benefit of that loss eventually, when you sell the shares for the final time and don't buy them back. So think of it as a timing rule, not a permanent denial. All right, let's switch gears completely now. We're moving on to the rules for personal use assets. This is stuff you own for your own enjoyment, not to make money. Things like your cottage, a boat, or maybe a piece of art. And believe me, the tax rules here are, well, they're pretty unique. So the law splits these assets into two baskets. The first is called personal use property, or PUP. This is most of the stuff you own, your car, furniture, a boat. Now, if you sell your boat for a profit, you have to pay tax on that gain. But if you sell it for a loss, too bad. The loss is deemed to be zero. You can't deduct it. The government's logic is that the loss in value is just the cost of you enjoying the item. But then there's a special subcategory called listed personal property, or LPP. This is stuff that can also be an investment, like art, stamps, coins, or jewelry. For these, you can deduct losses, but, and here's the catch, only against gains from other LPPs. And the rules for carrying over these LPP losses are also different. You get the same 3-year carryback that you do for regular capital losses. But for carrying them forward, you only get 7 years, not forever. So it's a use it or lose it situation within that time frame. And just to hammer it home, you can only use those losses to offset gains from other LPP items. Okay, last section. And this is a big one because it's a super common and often very expensive mistake that people make. We're talking about how losses interact with registered plans, like your RRSP or TFSA. So here is the trap. Please pay attention to this. Let's say you own some stock outside your RRSP, and it's gone down in value. If you transfer those shares directly in kind into your RRSP, that capital loss is gone. Poof. Deemed to be zero. You can never claim it. To do it the right way and actually claim that loss, you have to follow these steps. Step 1, sell the investment on the open market. That crystallizes your capital loss. Step 2, transfer the cash you got from the sale into your RRSP or TFSA. Now, if you still love that stock and want to own it in your registered plan, you have to wait at least 30 days after the sale. Why? Because the superficial loss rule applies here too. You and your RRSP are considered affiliated persons. So wait 30 days, then you can rebuy it inside the plan. So there you have it, a quick tour of some of the most important special rules for capital losses. Now, to wrap up today's lecture, I want to leave you with a question to chew on. We've talked about some pretty different exceptions here: the powerful ABIL, the tricky superficial loss rule, the quirky rules for personal property. So, which one of these do you think is the absolute most critical for a new investor to understand from the very beginning? And more importantly, why? Think about it, and we'll start our next class by discussing your answers.